Investors Chronicle.
Hello everyone, welcome to the Investors Chronicle Companies and Markets show. It's the 1st of August as we record, shortly after the Bank of England cut interest rates for the first time in 4 years. But we are sticking to the fundamentals. It's another busy week in results season, and we will start with the week's biggest FTSE riser. That's wealth manager St James's Place. You might not want to go to them for financial advice, but should you buy the shares? Julian Hofmann is here to discuss. Then we take a look at our cover story, all about rapid returns and how to make them in a sustainable, less volatile way, if such a thing isn't a contradiction in terms. Mark Robinson will talk us through things there. Then our personal finance writer, Holly McKechnie, will discuss some emerging star fund managers who've been producing impressive returns of their own. And finally, Julian will be back to talk about the signs of life at London Stock Exchange, which put out a decent set of half-year figures this morning. Before that, though, Julian, we're going to begin with SJP, as we say. The shares were up about 25%, I think, in the end on the day of the interim figures earlier this week. Well, what did you make of the results?
The results were exceptionally interesting because it was a case study in how investors will buy back into a story when a company can define what its liabilities are. As everyone will know, St James's Place was caught up in the possibility of overcharging in terms of fees that they were charging to their long-term customers. Controversially, things like exit fees for moving funds. They've accepted that they have to get rid of that model, and they've put aside about 426 million or so to cover any liabilities related to that. So in a sense, that issue is now parked. And what the results themselves showed was that St James's Place, for all of its past faults and sins, is still a gigantic money-making cash machine when it comes to drawing in inflows of funds. So in the 6 months, they drew in nearly 2 billion worth of new money to the business, which is a figure I think that most asset managers would kill for. And that was probably 600 or 700 million ahead of where the market thought it would be. So it sort of it illustrates really the strength of the brand, the fact that in many places the St James's Place is the only quality advisor around, and that it has a certain niche in parts of Middle England. So it was an intensely, if they're going to do future business case studies, then this is probably one of them. Also, the new chief executive, who's called Mark Fitzpatrick, he's essentially told them that they will deliver something like 500 million in savings over the next few years, starting with 100 million next year alone. The market got very excited by that idea, and it just illustrates really that the old business probably had quite a lot of fat in it that could be cut away. But it also, people have bought into this idea because so far he has done what he said he would, which was sort out its previous issues. So they're more inclined to believe his word when it comes to delivering future savings and profits. So that's why the shares took off suddenly, because everyone suddenly thought, well, actually the legacy issue seems to be fading, and here's all these exciting new cost cuts coming through, and the trough for the earnings consequently should be, while it's forecast to be next year, could be slightly earlier, so they could start growing a bit quicker than they had previously told the market they would. So it was a very interesting and fortunate set of results for anyone who bought in right at the bottom.
Yeah, as you say, it was very much a kind of a reset attempt with the new chief executive on board. The targets out to 2030, a lot of them predicated on cost cutting, which really drove the shares. I think there was also, as you mentioned, there has been a lot of talk about how the FCA consumer duty has been affecting St James's Place. Clearly, the shares reacted very badly to some of the changes that it was having to make last year and then again earlier this year. But there was some good news on that front too, in that I think you described it as being parked, but effectively the provisions they've put aside for that weren't increased in these results either, which suggests, for now at least, there's no further bad news on that front. They're not having to do a third fundamental reassessment.
Yeah, I think that's probably true. I mean, the FCA's work is not complete. I think you have to also emphasize that there's a certain element of uncertainty, but the fact that that they've made these provisions, and it doesn't look like there'll be any more provisions, at least not in this result cycle, has gives you a bit more confidence that we're moving towards a legacy issue rather than a live topic, and that kind of then gives people another look at the fundamentals of the business, which is it's still generating a lot of cash despite all the changes it's had to make, and the underlying cash result was amazing. They're still pulling in about 205 million pounds worth of just straightforward cash every year, and that's barely dropped on after all of this disruption.
Yeah, and likewise with the inflows, there would have been some concern, wouldn't there, that despite all the press St James's Place gets, it is rarely positive, but the inflows keep coming, and there might have been some concern among investors that this might have been the straw that broke the camel's back in terms of the Consumer Duty. The FCA regulations might have scared away some of those inflows, and while we can't sort of separate out the new business, as you mentioned, those net flows are still very strong.
I think I put it in the piece where when I wrote it, rather pompously probably, was that St James's Place would find a new rock on which to build its church. So this is essentially what we're seeing now in a non-ecclesiastical sense.
Indeed. There was some other positive news there as well, I think, or reassuring news as regards the amount of money they set aside to give their advisor base, because there have also been some concerns about effectively loans extended to advisors and the amount of funding that their partnership model requires internally, but that seems to have been parked for now as well. Let's talk about the valuation, because as you say, Julian, you did write the buy idea on them earlier in the year. I have to confess, I was quite skeptical at that stage, but I think the underlying point you made, notwithstanding the drop that's now been erased by this week's big increase, the underlying point you made was that the shares did look pretty cheap, and ultimately that's often what it comes down to. And is it fair to say that's still the case after this week's rise?
Well, I mean, they're no different from, the central situation is no different from when I wrote the story back in February. There might be some lingering low regulatory risk, but that looks increasingly parked. The customer base is loyal. I mean, I think that's the intangible here is how prepared are people to move to another provider, even if they have the opportunity to do so without paying vast amounts of fees. And the answer to that is, at least in the evidence of these results, is that the people who are upping sticks and moving is not huge. So that there is an inherent sort of stickiness to St James's Place's customers, and how much they're prepared to subscribe every year to the manager. And I felt that was being undervalued, at least back in February, and we're kind of back to a kind of a neutral position. So essentially, from now on, whatever it builds is essentially for free, I think, if you bought into the shares anytime soon.
Yeah, and the PE ratio is still pretty cheap relative, certainly to history and some peers as well. Still about 10 and a half times next year's earnings, I think, which isn't too bad.
Yeah, you were paying double that not that long ago. So you can see that a lot of risk has been now priced into that price.
Yeah, and I think it does also reflect that new, still lingering regulatory risk, doesn't it? But for now, it looks like things are fairly positive on that front.
You always have to caveat it, but ultimately the market probably got this slightly wrong in terms of the price drop, and it's probably come back to it's still cheap.
Right, it's time to move on though to our cover feature, Rapid Returns. Mark Robinson, Company's editor, you wrote this piece. Can you talk about it? Talk about the thinking behind the piece to begin with, because when people hear rapid returns, it may not be the kind of return that you are talking about in this article.
Yes, excuse me. On that basis, I questioned the the naming of the article itself. But what I was really trying to arrive at, whether it's possible to generate long-term value in a portfolio by looking at rapid returns in the near term. It's analogous in some ways to what traders, how they go about their business, but again, not exactly. And when I was looking at it as well, to be quite honest, the reread is somewhat quizzical in nature, because the more that I thought about the subject, the more questions kept on popping into my head. So I'm not sure whether the article itself is indicative, let alone definitive. But it centers on the fact that we should look beyond the standard orthodox view of the way that you sort of put your portfolio together. It has something to do, I guess, with a reactionary stance of mine about the growing preponderance of passive strategies as well. My concern there is that as time goes on, they become more prominent in the market. We're heading towards a situation of permanent beta. So yeah, I mean, I say it's analogous to the way that traders go about their business, but it's not exactly in line. And if I'm going to pursue that ecclesiastical theme a bit more, it's I guess it's a bit like St. Thomas Aquinas pondering on the Trinity, the nature of the Trinity. So as I say, and I was asking questions of myself in relation to the orthodox view about staying invested in the market, because study after study was shown that that's the way to build wealth over the long run, the low-risk way of building wealth over the long run. And, in the magazine, you'll often see references to people like Benjamin Graham on that front. But I just wanted to examine whether it was possible to switch allocations in expectation of near-term market changes. That's the way that traders go about their business. But it isn't always the case. We've got an equity portfolio. And there's an obvious, overlap here with strategic market allocations.
Mm. Well, one thing you talking about in the piece, I mean, I'm half tempted to ask more questions about Aquinas and the Trinity.
Well, of course, yes.
But maybe we'll save that for another podcast. The same, but not identical, I believe, is what he was saying in that case. But one thing you talk about in this piece is mean reversion and how that can be used as a source of an alternative source, if you will, of rapid returns potentially.
Well, exactly. And I mean, if you buy into the theory, and I think most people do, it's something that, in my experience anyway, and certainly with the retail market, that people don't pay enough attention to, and yet it looks like an open goal to me in many. All things being equal, pari passu within a market, a stock's value or the value of anything will actually revert back to its mean over the long run. And I don't think that retail investors look enough at that. And the way to utilize that within a rapid returns policy is fairly obvious. I do point as well. It's a linked subject when you look at moving averages too, and especially if you look at medium-term averages, say 200 days to 300 days, and how that relates to the shorter time frame over 50 days. If you get the short measure dipping below that 200-day measure, then that's a signal. That's a negative signal. What they call the death cross. Conversely, if it rises above the 200-day moving average, then it's called the golden cross. It's quite a sort of a crude way of looking at the market, but I keep an eye on this all the time, and it is surprising how often that comes to pass. So you could use that certainly as a measure, and also look at the relationship between value and growth indices too, as another indicator that you might base some short-term decisions upon. I mean, I'm not talking about, when I'm talking about rapid returns, I'm not talking about a frequent trading policy, but just looking at sort of either wider trends or even numeric ones, like you say, with mean reversion. Also talk about dividends in the piece too.
Yeah. That's quite an interesting aspect, because people would think of them in many ways as being the opposite of a rapid return, but there is some interesting thoughts there.
Yeah, I mean, within a standard portfolio, you reinvest your dividends, and you boost your total return over the life of the portfolio. Everyone knows that. Most people follow that as well. But you should be able to exploit certain correlations in the market when you look at it. Interest rates have been trimmed today, but here's an example. During the period when we had high inflation, it was pretty obvious that at some point the Bank of England and other central banks were going to start ratcheting up interest rates. And you ask yourself, well, what happens then? Well, that's actually, you can find a strong correlation between returns within the financial sector and interest rates on that basis, particularly amongst the large cap stocks that do tend to pay dividends too. So if you acknowledge this in advance, you could allocate a certain proportion of your portfolio to exploit this. Likewise with the commodity markets as well. There's a direct correlation between returns from the oil majors, say, in an elong period of elevated oil and gas prices. So that's just a couple of obvious examples there, but it's the type of thing that I was getting at in the article.
Yeah. One thing we should talk about, you do mention in the piece as well, we've alluded to it a couple of times already, but options and trading and things like that, short-term decision-making in the US in particular, or maybe to an extent here as well, certainly when it comes to US big tech shares, there's been a lot of coverage in recent months, years about the increasing preponderance of options usage among private investors, people trying to make these very quick returns, trying to make them on a small number of shares as well. There are clearly warning signs here insofar as these things you can make a quick buck, if you will, but it can often go the other way too. And it's not really, in an ideal world, the way the market should or would be going from a private investor perspective.
Yeah, I certainly wouldn't want to give the impression that I think there's a way forward for our readership because the use of options, or in fact any derivatives, requires a degree of sophistication, even though they're the oldest type of financial instruments in a sense. So yeah, I mean, even if you're looking at exchange traded funds, the way that they're calculated over the year isn't as straightforward as you might imagine. CFDs, any sort of leverage instruments like that, are inherently risky. But I mean, the platforms that put these out make this perfectly clear as well. And I guess it's anything within the investment world, you've got to weigh up that risk-reward relationship as well. But I still think it's possible to combine like a long-term investment horizon with a relatively high tolerance for risk. It comes down again to that allocation. The usual thing is when you're starting out in your investment career, for want of a better term, you're going to take on a little bit more risk to try and boost those near-term gains. But I still don't think there's any reason why you shouldn't be doing that, even if you're approaching retirement. You shouldn't give up on risk altogether. So I guess looking at the piece now, I mean, I hope I get a little bit of feedback about it from the readers, because I'd be interested to find out what people think about the subject as well. We tend to be conservative at the magazine in terms of our recommendations on investment, and I think that's generally quite apt. But you've got to enjoy yourself as well.
Of course, it's a big part of it, I think, for all our readers too and listeners. So, as Mark says, that is in the magazine online this week. If you want to have a look and give him some feedback, please do so. Now we're going to turn, though, to a look at people trying to make returns, well, in both the short and the long term. That's the professional fund managers who manage many of the funds which we cover in the magazine online. Holly, you've written about some potential emerging star fund managers. Can you say a bit, first of all, about this question the obvious question that springs to mind is what makes a rising star or even a star fund manager? Is particularly pertinent in the case of newer names because you have less information to rely on, but what kind of things can you look for?
Yeah, so I suppose inevitably the issue is that an emerging star fund manager doesn't have a long track record, so it can make it quite difficult to analyse their performance. So one sort of way of getting around that is to look at whether or not they've been tested in sufficiently different market conditions. So not just different market conditions, but market conditions that don't necessarily suit themselves well to the investing style of that fund manager. And if they've managed to sort of perform okay through them, that's normally quite a good sign that they're doing okay and that they're not just on a lucky streak and the market's working out well for them. And I guess the other challenge is that the industry more generally has moved away from this sort of concept of a star fund manager. So you're not going to see, like in their marketing materials, them pushing individual names in the way that you once would. So that can make it a little bit more challenging. So one way to get around that is to look at who's backing the emerging fund managers, who's sort of pushing their junior fund managers, giving them opportunities, and then look at the wider team, the people you trust, is that working well, and the sort of processes and procedures behind those funds. And again, is that something that you agree with and see playing out well in the long run?
Yeah. Yeah, a number of good points there. Certainly the case that after I suppose the high-profile failure of some quote-unquote star fund managers, that asset management groups do try and promote more of a team approach nowadays. It also helps them if the main person leaves, they can say, well, it's a team approach, et cetera, et cetera. That does, though, make it harder to discern sometimes who the brains of the operations are. That the first point about different market conditions, I think, is also important. I mean, when for example, things go awry for a part of an investor's portfolio, it can be, I think, tempting to either, bury your head in the sand or to think, oh, should I just sell this straight away? But you can actually learn a lot in those moments, certainly when it comes to funds, as to how their performance is going. Maybe it's not quite as bad as you may have thought. Maybe it's, relatively speaking, better than peers. And as you say, you can see then how much skill is involved when the tide goes out, as it were. What about some of the specific people then that we identify in the feature? I think there's a couple of sectors you focused on in particular. UK small caps, which, as a lot of our readers and listeners will know, is a good hunting ground for an investor, and also global equity fund managers. Let's start with the small caps. Who are some of the people we've identified and that people we've spoken to have identified as well?
Yeah, absolutely. So in the small cap space, you've got Joshua Northrop and Sean O'Flanagan. So they manage the Whitman UK Small Cap Growth Fund. And their sort of approach is to look for companies with the potential to significantly grow earnings. They've had a bit of takeover activity in their fund recently after a couple of years' bad performance. So now fund buyers are sort of circling them and looking at what they're going to do next. You've also got Adam Rackley at the Cape Wrath Focus Fund. He looks to buy oversold shares, sort of takes the investment philosophy that the best opportunities occur after a period of disappointment, has then created emotional reasons not to invest, so he likes to swoop in those times. Mm-hmm. So that's another one fund buyers are quite interested in. Sort of on the global share space, you've got Sean Pesh at the Ranmore Global Equity Fund. So that's a value fund. And the fund buyers I spoke to for this piece were really complimentary about his stock picking skills. And again, that fund went through a sort of period of not doing quite so well, but over the last 3 or 4 years has done really well. Then you've got the Lion Trust Global Dividend Fund, which is managed by Storm Uru and James Dowie. So that fund focuses on companies that are sort of innovative enough to outperform their rivals. So there's quite a lot of well-known names in there. So you've got NVIDIA and Microsoft. But as a sort of team, those two are very good at sort of working out when's best to buy and sell stocks. So that was something, again, fund managers were really complimentary about.
Yeah. It's interesting. Most of those names there, the company names at least, are quite less heralded. They're certainly not the big asset managers. Lion Trust will be known to a lot of people, but the likes of Whitman and Cape Wrath and Ranmore, not certainly the kind of fund houses who have 101 funds available on the investment platform. They tend to run just a handful, which can be, certainly there is some evidence to suggest that these boutique fund managers can do particularly well. It's a good environment for professionals to work in. There's no groupthink, certainly. There's no management pressure to the same extent that there can be in big asset managers. At the same time, though, I suppose they can also bring potential, not concerns, but risks to watch out for when you're dealing with a manager on the up. One of which would be if the fund is not of an adequate size, for example.
Yeah, exactly. I think there's a few things you need to sort of take into account when you're looking for emerging managers. And the fund size could be an issue because it might be too small and therefore more risk of closure. There's also just the possibility that you might pick wrong and pick somebody who's going to dramatically underperform because you've not got the sort of track record there. So one advantage of picking somebody earlier on in their career is that they're further away from retirement, so you've not got that sort of succession planning angle to worry about so much. But then equally, if they're young, ambitious, looking for different opportunities, they're also possibly more susceptible to accepting an offer at a different firm. And then if the succession planning hasn't been there, then that, which it might not have been because they might have been anticipating a much longer run, then that can potentially cause issues.
Yeah, and then you're left with the decision of whether to follow them to their firm, and it means more churn in your portfolio, which is not ideal. And certainly that's the professional fund selectors have to deal with that all the time. From a private investor point of view, you obviously want to try and do buy and hold as much as you can, so there can be risks there. Well, this piece is online. It was in last week's issue of the magazine as well. There's lots more detail on those names and some good insights into what to look for if you are trying to find I won't say contrarian, but something a little bit different from the norm in the active fund management part of your portfolio. We're going to conclude with another company, London Stock Exchange, reporting results this morning, Thursday as we record, as I say. This is a company we followed quite closely for a while. We did include it in our ideas of the year at the start of the year. It's been one of the relative laggards, but done fairly well. And today's results seem fairly positive as well, Julian.
Yes, they were. Obviously, London Stock Exchange is now very much a data and analytics company. It's the actual stock exchange bit of it is a very small part of the overall business since it took over Refinitiv a couple of years ago. That consolidation process is largely complete as we look at it, and the results from this half year were quite positive in that the company showed evidence that people are subscribing in steadier high numbers for its data analytical services. So they were up by about 6.4% in terms of number of subscriptions. And there was a certain amount of evidence that that's increasing as the year goes on, which obviously a sign of confidence, I imagine, on behalf of their clients. It's an interesting story in terms of how a venerable but sort of slightly faded business regenerates itself. And actually, it was two sort of venerable but faded businesses that came together. And the combination in tandem seems to have worked very well. In terms of their cash generation, they're producing a ton of free cash every half, despite the fact that they're geared at about 30% of the balance sheet, and they owe people still about 7 billion in terms of the cost of the original deal. But it is showing signs, I think, of significant operational gearing. The half-year results, interestingly, were much more positively received than the last full-year results. So I think what we're seeing in this half-year, and as the year goes through, is that the overhang from the original consolidation has now faded out, and everyone's looking at more about its prospects rather than having to deal with the issues around bashing two quite big companies together. Yeah, so very positive. And David Schwimmer, no relation, he told the stock market that there was a key deal with Microsoft. They're getting together to produce new products, and that partnership looks to be on track, and they'll deliver the first product out of that partnership somewhere before the end of the year. So yes, it looks like operationally the group is doing very well, and it is unfortunately then highly rated nowadays because of that. Really, it's rated more like a tech company at something like 29 times. But they are jacking up the dividend quite substantially. You managed to get a 15% increase at these results. And I suppose if you want an ultra secure dividend share, this is possibly one of them. I don't know how much share price growth you're going to get out of such a big and mature business, but it's definitely a latter success story.
I think there's still some potential there as well in terms of it's a bit like Relex in a way. It's very highly valued for the UK market, but when you look at overseas peers, there is still some catch-up potential. It's the kind of business which our tech businesses are are relatively low-key in terms of what they do with their tech, but they are on high ratings nonetheless.
Yeah, some of the equivalents in America are like 46 times earnings. It's so there isn't really you could say it's a good value. It's a good value high growth share.
Yeah. The Microsoft deal, I wanted to touch on that. Microsoft took a 4% stake in LSE as well as part of it. And there was also some positive commentary in these figures about the workspace platform which LSE offers. Seems to have been, or what they're saying is it's taking market share, beating some competitors, which is what you want in a financial data business where everything's very competitive. Seems to me, I mean, they've been working to integrate that with Microsoft Office, things like that, which sounds like a very basic function, but having the Microsoft deal in place and being able to offer that would seem to me to be quite valuable as well, because despite it being 2024, a lot of people do still rely on Office for their financial data services, even professional financial services businesses. So if you can offer a cloud platform that integrates well with that, then there's the potential there for some growth, you would hope.
Yeah, you'd say so. I mean, it's going to be a long time. I mean, the partnership they have with Microsoft is 10 years to get that solution into place. So I wouldn't hold your breath too much on having too much near-term impact, but it's definitely a very positive long-term deal for the LSE. And as you say, the trend really is towards cloud computing, and financial services and financial data is all going to be part of that, I think.
Yeah.
Yeah, but as we do, we rely on that. We rely on that as much as anyone.
Well, indeed, you can't be a bit of Excel for financial analysis, certainly at a journalistic level, I think. Yeah, there seem to be a number of strands to the Microsoft deal as well. So hopefully, from LSE's point of view, some they can roll out in the short term as well as the medium and long term. That, though, does bring us to the end of today's show. We have unfortunately run out of time. So thank you very much to Julian, to Holly, to Mark, to our producer, Maddie Apthorpe, and to you for listening. We'll be back next time with another Companies and Markets show.